Welcome back, traders and investors. We have Riad Younes on the line, and he is co-portfolio manager at RSQ International Equity Fund. He's going to be discussing investment opportunities in the emerging markets. Riad, how you doing today?
I'm doing well, Joel. Thank you for asking. How are you?
We're doing good here on Benzinga's pre-market prep, brought to you by Options House. So you like to focus on the emerging markets, particularly Europe and Japan. So what are you seeing over there? We've had a great run in our markets and their markets as well. What's your forecast for the European markets?
Yes, Joel, we focus on international equity market, not just emerging market, but as well developed market outside the U.S. We see mostly opportunities in Europe on a 3 to 5 year view, and mainly due to depressed valuations.
Okay, all right. So looking at the valuations now, are you still comfortable investing, in the market at these valuations?
Well, again, in Europe, yes. Here we are 30% higher than the previous peak, and the multiples are kind of extended, and the margins are at historical high. While in Europe, almost everything else is the opposite. There are many companies who are trading below tangible book, yet they have dominant franchises in Europe. And the reason for this opportunity is because Europe has been hit by two big storms. The first one is structural in nature because of the euro area challenges and the fault line in that project. And the second problem is the current cyclical downturn. So over the next 2 to 5 years, we feel many of those structural and cyclical wrinkles will be ironed out. And as that happens, we feel the market will start to re-rate and we'll get to much more normal valuations.
Okay. When the market had its on the way up here from the 2009 lows, we did run into some problems in 2012 with the European banks, the crisis going on in Greece and whatnot. And now you take a look at some of these European bank charts, Deutsche Bank here in particular. I mean, that is not a healthy looking chart by any stretch of the imagination. What do you think the problems are over there, and do you think that they're
Yes,
going to get turned around?
it's a very good question, Joel. What we do like in Europe, we don't like very much these capital market banks like Deutsche Bank, for example, because they're extremely leveraged, and we believe in investment banking in general. It's going to be very difficult to make the same amount of money as I made in the past due to the much higher regulation and the much lower leverage that we're allowed to have. What we are really interested in is really retail banking franchise, boring brands like the Wells Fargo of the U.S., for example. There are many banks, whether it's in Europe or in Scandinavia, Canada, and Australia, where they're very boring and have very high ROE. So we look at purely retail banking franchises that just take deposit and they lend. These companies are very valuable and should have very high ROE. And
Okay.
stay away from investment banking and universal banks.
Okay. All right. So, and moving over to Japan, they seem to be stabilizing. What's your outlook for the Japanese markets?
Yeah, in Japan we are kind of like neutral because the prime minister had three arrows or three catalysts to revive the economy. Getting a weaker currency was one of them. Have fiscal spending is another one. The third one, which is much more difficult, is regarding structural reform. Structural reform, as we've seen everywhere, whether in the U.S., Europe, or Japan, these things it's a very slow process, and usually you get more pain than gain at the beginning of it. So we are kind of hesitant to be bullish on Japan because the structural reforms are not going to be as easy as the other two engines.
When when discussing, individual portfolios, people like to have, different asset classes in it. And now with investing in it, emerging markets, for your clients or for yourself, what kind of exposure do you think people should have? Let's say for U.S. versus emerging markets, Europe and Japan. How important is that for investors?
Diversification is always important for investor. That's basically if there is any kind of agreement, unanimous agreement about any investor you speak with, diversification is a must. Now, how much to have in different asset classes? Usually, it depends on valuation and as well, equally important on the risk tolerance that the investor has. Emerging market tend to be much more volatile and much less liquid than the developed markets, and therefore that could be taken into consideration when investors are allocating part of their asset to that region.
Okay, so looking at that, with all the markets kind of, at very high levels, where's the best place, of all the different U.S. markets and emerging markets? What's the best place you think to have your funds right now, and perhaps where would be a place to perhaps take some profits?
Definitely in the high growth, high multiple names and teams where they run up a lot and multiple high expanded. Definitely, we advise to take profits, and where there is value and you have high dividend yield income, we believe these are good and less speculative in nature. These are good places to park your money because one key reason for that, in our opinion, is we believe interest rates are going to be low for longer than the market expect, and in a very low interest rate environment, high yielding stock will do extremely well.
So from that statement, it doesn't sound like you mess with the momentum stocks that much, like the Facebooks and the Twitters.
Correct. Yes. I mean, without getting into specific of these names, in aggregate, we feel like because there is not a lot of growth in the world, any company or any sector that provides some kind of growth, we think they've been bid up aggressively, and the risk return are not attractive.
Okay, and then for the dividend, I mean, that's really what's been driving the market, the low interest rates. People
Correct.
using, high dividend stocks, basically as a substitute for treasury bills and CDs, which are almost,
Exactly.
non-existent here. The Fed has, come out and they've kind of intimated that they're going to be changing their stance, and you're kind of looking at that as hogwash.
No. I mean, the key thing to understand is we cannot have zero rates forever. They're going to, and we cannot have QE forever, as we have realized. So the QE is going to end by the end of this year, and maybe by the middle of next year, they're going to start raising rate. The thing important to understand, I think, that the rate of increase is going to be very slow, and REIT may peak around 2%. So it's not like they're going to go up to 5 or 6% in short-term rates. We think really rates will peak around 2% for at most for the next 3 years. So therefore, still, even after they've done kind of tightening, this is going to be relatively yields on treasury are going to be too low, and people still will need higher returns, and they're going to keep seeking risk.
Right. So even if they bump up to 2%, I mean that's
Still too low.
yeah, it's still too low compared to some of the yields. For some of these high yield dividend stocks, I mean there's always the fear that they're going to cut the dividend. Do you have any kind of like downside protection in any of these stocks that are they're paying these high dividends? Do you use the options markets or anything to hedge against a dividend cut?
No, not really. But I mean, we don't use option actively in our management, but you have to protect yourself. I mean, you mentioned something very important. High yield, you have to be very careful that you have to make sure that the company is able to maintain that dividend. Therefore, you look at the payout ratio, which means what percentage of the profit is used to pay the dividend. The higher the percentage, the more the company is stretched. Also, you look at if the company has been growing dividend. If company has been growing dividend, usually it's a good sign that the dividend is sustainable and the company is in a very good position. A high dividend yield is a necessary but not sufficient condition. So you need to have safety and you need to have visibility of that dividend.
And sometimes people, interpret, an increasing dividend and stock buybacks is really, they're not reinvesting in the company. They're not coming up, new ways for growth. I mean, but is that
Yes,
is that something
that's
that
not bad. I mean, the key important about management is uh, the allocation of capital, good allocation of capital. So every company have a certain growth prospect. So if you have more cash than your growth needs, it makes much more sense to give it back to shareholders than to invest in lower return projects or even go into some value destroying project like acquisition and the like. That's why they're cheap. So basically, modest to low growth companies with high cash generation, they're not going to have very high multiples, and they would have very high payout ratio. Companies that are growing very fast, then they have very low payout ratio and they have much higher valuation. So every company should live and should be managed based on its own growth prospects.
Okay, and just to close things out, just your short-term and long-term take on the U.S. markets. I mean, just hanging up near all-time highs here, coming into earnings season here. Any reason for caution in the U.S. market, either in the short term or the long term?
Of course, I mean, you need to be very cautious because the market has tripled from the low almost. Key to understand that the multiples are relatively high, but even they are much higher than they look if you adjust the margins, which is almost double historical average. So it's difficult to see what the catalyst is for a correction, but for now, especially with the visibility for interest rates as they're going to be low for some time, it's difficult to fight the market, but definitely it's by no means cheap.
Okay, we have Riad Younes on the line, co-portfolio manager at RSQ International Equity Fund, giving us his take on emerging markets and growth markets. Thanks a lot for coming on, Riad. We hope to have you on again.
Thank you, Joel.
Okay, thank you.